Are you thinking about buying a house this year? Make sure to stay to the very end of this video. I'm going to give you 5 tips to help you get through your loan application so you can get qualified. Number 1, make sure that you understand your credit score. Many times borrowers will come into the application not even knowing what's on their credit report. There's a lot of services out there like Credit Karma, Credit Sesame, Experian.com that you can get a rough ballpark of where your score is, what's on the credit report. But remember, just because you see an amazing credit score on Credit Karma, that doesn't necessarily mean that's the score that your lender is going to use. More often than not, when a mortgage lender pulls your credit report, it's going to be probably 50 or so points lower than what you might see on Credit Karma. So don't take it as gospel. Just use it as a good rule of thumb. Use it as a good baseline to see, are there any inaccuracies that are reporting on your credit report? Did someone take your identity? Did someone open a credit card that's not yours? There's a lot of these things that come up on your credit report that a lot of us are unaware of. So if buying a house is a goal of yours, get familiar with your credit score because you want to be able to improve your score as much as you can. That way, when you do qualify, it makes it a lot easier. You don't need perfect credit, however, to purchase. So don't let that be a reason why you're not buying or why you're delaying the opportunity to purchase, because most lenders can go as low as a 580 credit score to get you into a home. But like anything else that I always share with you, make sure to run the numbers, because at a 580 credit score, I've seen a lot of clients purchase and become very successful with their real estate investment simply because they were able to get into the house, get their foot in the door, and they seized that moment. Remember, every moment's going to be different from you, from your friend, from a family member that bought a house. So just because they are telling you not to buy, you need to figure that number out for yourself. And number 1, start with your credit. And number 2, you want to have a stable job. You don't have to be on your current job for 2 years. You have to be in the same line of work for 2 years. This employment situation is a big myth within the industry. Many borrowers out there still feel to this day they have to be at their job for 2 years. So for a lot of you, because of COVID and everything else that happened, you might have changed employers, you might have changed jobs, and now you're thinking, I've got to wait 2 years before I can buy. That's not always the case. Typically, we want to see, again, that you've been in the line of work for 2 years or you have a 2-year history. If you're bouncing around every 6 months, that does become a problem because it's not a stable history and it's difficult for your lender to calculate your income. So you want to try to stay at your job as long as you can. If you have a promotion that's potentially coming down the pipe, you're possibly changing jobs, communicate that to your lender so we can best give you some advice to help you get into your house. I've had a number of clients lately that took promotions, didn't disclose any of that information to us, that actually costed them from buying a home. Because we have to look at whether you're being paid a 1099 or are you a W-2 employee. There's 2 different qualifications for those types of clients. So you can't just go hop from a W-2, go start your own business thinking that, hey, I can buy a house. It's not going to happen. You're going to have to wait. So make sure your job is stable so you don't have any issues with the application. Number 3, figure out your down payment. Another big myth, you have to have 20%. That's totally false, so you can throw that out the window. You just need to have at least 3.5% down as a bare minimum for a down payment. And I've also shared this with you. There are numerous down payment assistance programs all across the country. Sometimes your employers are willing to gift you the down payment. Sometimes if you work in a certain industry like the medical field or you're a first responder, there are down payment assistance programs all out there that are willing to help you guys get into a home, especially teachers. There's teachers programs all over the country. You just have to be a little resourceful. Talk to your lender. When they're taking your application and they ask you about your job history, this should automatically throw up a flag for them to start looking into some of these programs so that way they can help minimize your out-of-pocket expenses. But not only figuring out the down payment, you need to be able to document the down payment. I recently spoke to a client that had about $40,000 of cash sitting in their house, and he wanted to be able to use that as part of buying the home. I can't use cash. No lender is going to accept that. We have to be able to get the money into your bank account in order for us to use it. Because of all the anti-money laundering laws that are out there, We have to verify where the funds are coming from. So if your mom or dad is going to gift you some money, we have to be able to document that. It's got to come from an account that we can source. They can't just give you cash. Here in Las Vegas, it's a problem for a lot of you because you get tips, but that's fine. That's part of the industry. So as long as we can show a history of you depositing your tips into your checking account, we can use those funds. But if you go to the casino, you gamble, you got some big winnings, maybe you bet on sports, you got a lot of cash at home, the money has got to be in your account, or else it's a big no-no. You're going to have to wait a couple of months to season the funds in order for us to qualify you. Number 4, try to figure out what your debt to income ratio is. This is something that you need to have a rough idea as to where you stand. And the issue that comes up when we qualify a lot of borrowers is that they are looking at maybe their net income when they're qualifying, which if you are a W-2 employee, we look at your gross income. So this is the money you make before your taxes and any deductions come out of your payroll. So look at that number and look at the monthly minimum payments on your credit report. Many of you that I talk to look at your gross amount of debt that's owed. And some of you think like, hey, I've got $100,000 of debt. I can't buy a house yet. No, that's totally false because your credit card payments could be $50, right? We're not looking at the $5,000 balance that's there. It's literally the $50 payment that you owe. Or some of you take into account maybe your car insurance, maybe your utility bills. That's not part of your debt to income ratio. All we look at is what's being reported on your credit report, which was my number 1 point to you, was know your credit. So that's why it's so important, because there's so many things that get reported on there that 1, you want to make sure it's accurate, but 2, it's part of your DTI qualifications. So as a lender, I have to be able to figure out that number for you, because that ratio will essentially determine whether or not you can or cannot purchase a home. For those of you that are self-employed, here's the biggest hurdle every single one of you will have. You make a ton of money. Your top line number is always amazing, but you all have great accountants as well. And an accountant's job, or a CPA, is to limit your tax exposure so you don't have to pay a ton of taxes to the IRS. So there's write-offs and everything else that you take during your business, whether it's you're writing off an iPad, maybe you're writing off your camera equipment like we do. That lowers your gross income. At the end of the year, you will then report your certain net income on your tax returns, and that's what gets claimed to the IRS as your taxable income. As a lender, when I qualify you, I'm looking at that net income. Now, the argument then ensues at that point with every self-employed client. Well, I made $500,000 last year, Sean. You did, but you wrote off $400,000 of it. And that's what you're telling the IRS that you made. You're paying taxes on $100,000. So if you're self-employed and you want to buy a house, that's something you have to address, not only with your lender, but with your CPA. Your CPA is doing an amazing job and lowering your tax exposure, but it hurts when your lender looks at it when they qualify. So a lot of our self-employed clients, we actually work with their CPA to find a happy medium of income that they can show on their taxes so they can qualify for a traditional mortgage, and they don't get killed when it comes tax time. So this is where having a good team comes into play, and knowing your DTI is super important. And last but not least, come up with a plan and come up with a budget. Buying a house is not something that you just wake up tomorrow and you go talk to a lender to buy a home. For many of you, it takes months. It's going to involve planning. It's going to involve budgeting. It might even involve paying off some old debt. Maybe it's hanging over your head. You made some stupid mistakes back in college and you just try to ignore it and just think that it'll never come back to haunt you, but it still is. These are all the things that buying a house involves and it entails. So make sure that you come up with a good plan for yourself, especially in the market that we're in today. With all the talks of inflation and the recession, you want to make sure that you are buying a home that you can truly qualify for and you're comfortable making that payment. Forget what the house is worth. Forget what the real estate market is doing. You need to look at your own finances and say, I'm comfortable paying X dollars per month. Can I qualify for that? And how much house does that then get me? Because if you go and chase the house first, you're then going to be probably disappointed as to how much the payment might be. So you really need to figure out, by just running through some of these scenarios with yourself, as to what I'm comfortable paying, what are my total expenses every month, what am I spending maybe on Netflix and Hulu and some of these other streaming and automated monthly payments that we all take on, food delivery service, Postmates, all these things that rack up every single month that eat into your expenses and your ability to possibly save money and get yourself maybe even out of a hole. So coming up with a budget is a really big decision, because once you do own a home and now you're building equity, the last thing you want to do is overspend, become house poor, and put yourself in a bad spot to where you could potentially lose your house. And for some of those people that have made mistakes in the past, they lost thousands and maybe even hundreds of thousands of dollars of future equity in the property. Or for those of you that actually had no idea you had equity and maybe someone took advantage of you, got you to sell their home because you needed some cash because you're in a pinch. There's a lot of guys that look for that kind of stuff, and they will literally take advantage of the situation of your bad budgeting, and they're going to sell your home for a profit. And I would hate for any of you to be in that situation. Those are my 5 secrets and strategies that you can do to make sure you get qualified for a home loan. And if you have specific questions on your scenario, send me an email. We can talk offline, and I'd be happy to help you with your home purchase anywhere across the country. Thanks for watching, and I'll see you on the next video.